1.13. Is that where the core of your focus is today?
I think it is, and I'll just label it for today. I'm not waking up in the middle of the night worrying about it, at least not yet, Scott. But you've heard me say many times over the past few months that current market multiples are justified by the low interest rate environment. Well, guess what? We're not at 0.7% on the 10-year anymore. We're up at 1.13 last I looked. I think, but I don't know, I think 1.35% is where the market might say, hey, wait a second, maybe we've got to rethink this. This could be a case of, give with one hand, take away on the others. The 10-year rising certainly helps the financial stocks. We've been seeing that. But you don't want to see the Microsofts and the Apples and the Googles of the world, which I've been saying are absolutely fine at 29 times forward earnings. You don't want to see those come down to 25 times forward earnings. If we stay right where we are on the 10-year, I'm fine. So the question then is, at what point does the Fed starts to put its thumb on the finger and buy bonds in mass to keep the interest rates where they are or lower? Okay. That's the burning question on my mind.
Yeah, good points all, for sure. And Shannon, this idea of rates going up, multiples getting compressed on some of those leadership stocks on the minds of a lot of people today. Morgan Stanley's Mike Wilson, higher rates, he says, the wild card could begin a period of falling equity valuations, making earnings revisions even more important than usual for stock performance. So how closely are you watching rising interest rates and the impact it could have on the market?
I think the perception of, and to Jim's point, I don't disagree. I think we get up into closer to 1.5%. I think the markets start to get a little nervous. But, historically, you just think about being under 2% on the 10-year. That handle has certainly never been constricting to companies to borrow. We saw massive issuance last year. Corporate bond issuance set a record last year. And we expect there to be continued issuance this year. So it's really about financial conditions, the relative opportunity in bonds. And I think that, from a constraint perspective on companies' earnings, the debt coverage, I don't worry too much about that. I do think that there's a perception, however, that this points to higher inflation and higher growth. And those are two reasons why, if the yield curve steepens, that's a positive thing. We're not seeing that. I do think that we're in a period where we certainly could anticipate some central bank intervention. If we start to see rates rise and the equity markets react negatively, Powell has made it very clear that he intends to use his balance sheet and use quantitative easing as necessary. And so I think that this affects our outlook for financials. I think if you think about the rising, steepening yield curve, where, that certainly points to some good earnings or good expectations for financials over the next couple of quarters. So this is important not only from an overall market perspective, but also as it relates to some of the positioning that many institutional investors have put on over the last couple of months.
Wow. So, I've got a couple good things to work with here, Weiss. I've got two people that have gone to already who are expecting the Fed, the cavalry, to come to the rescue no matter what, continuously, right? If rates start going up too fast, I've got Shannon and Jim talking about the Fed coming into the game again. So that's what we're now reliant on. And I also find it quite telling today, frankly, that nobody on the desk today, nobody on this panel has made any key moves in any stock names over the past number of days, at least, handful to mention on this program today. Steve, what does that say about what you're thinking about in the market?
Well, as to equity exposure and no key moves, I'm comfortable with my exposure. I'm pretty much fully invested, which is very, very unusual for me. I carry at least 20% cash and am rarely caught without 10% cash. This is one of those times where I'm caught without 10% cash. So I'm very comfortable, so I can't really make moves. I trade here and there if there's a great opportunity in a name that I own, I'm familiar with, oversold, overbought. But in terms of rates, look, there's so much talk about rates going on. By the time we get to 2%, it's going to be so ingrained in the market's not really going to care, because the growth story, as we get through what's a very troubled time for the economy now still, and can be a little misleading because the disconnect between the economy and the market is so glaring, that I think that we're pretty much going to be immune to the rate increase to 2% as long as it doesn't happen tomorrow or the next day.
But we can't,
so it's going to be the rate of change.
Listening to Shannon and Jim, it sounds like the market's not even going to be able to handle 1.3 to 1.5%. That's going to cause the Fed to come back out of the basement and start doing stuff again. So we can't stand on our own 2 feet. That doesn't tell me that the market's in such a strong place.
So I would come back to them and I'd say, Jim, are you going to sell Boeing if rates get to 1.3 or 1.5%? I'd go to Shannon and say, what are you going to sell when we get to 1.3 or 1.5%? How is that going to impact your portfolio? This time is going to be different. Words we all hate to say. All words we hate to say and hate to hear, but it is. Because we have very supportive Fed. I don't know if they ride to the rescue, but the fiscal stimulus we're going to see from the Biden administration is going to blow your socks off. So I think we're okay. And not only from the Fed here, but globally, it's still easy money. And 2% still historically very, very low.